Welcome back, finance enthusiasts. The SIE Securities Industry Essential Exam is an excellent way to begin your career in the financial investment sector. It encompasses the fundamentals of the industry and prepares you for more advanced examinations. Now let us continue preparing you to pass the Securities Industry Essentials SIE exam and end this segment with a discussion on rights and warrants derivative securities, the follow-up from our two previous videos on equities, and classifications of stocks. Let us begin with an overview of rights and warrants derivative securities. The goal of this segment in the series is to enhance a person's understanding of the following equity-related concepts: features of ownership, such as order of liquidation and limited liability, voting rights, convertibility, as well as control and restrictions, like SEC Rule 144. The process of issuing and trading these securities will be discussed in subsequent segments of this series. Rights and warrants derivative securities. Derivative securities are special types of investments that track the value of common stock or another underlying asset. For example, imagine a security that grants the owner the opportunity to buy 100 shares of ABC stock at $75 per share, regardless of how high the stock may rise. This situation mirrors what a warrant buyer experiences. If ABC rises above $75, the warrant has value since the investor can buy shares at a price lower than the current market price. Conversely, if ABC falls below $75, the warrant will have little value as ABC stock can be purchased in the market at a better price than what is available through the warrant. The following section will examine two types of derivatives issued by a corporation, rights and warrants. In a later segment of this series, we will explore options contracts, a different type of derivative often issued by a third party, such as the Options Clearing Corporation, OCC. Preemptive rights. An exclusive privilege for common stockholders is their potential entitlement to preemptive rights. If a corporation seeks to raise additional capital and intends to issue more shares of stock, it may conduct a rights offering to provide current shareholders with the opportunity to purchase the shares before they are offered to the public. By participating in the offering, current shareholders can maintain their percentage of ownership in the company. If shareholders choose not to subscribe to the offering, their ownership percentage and ability to influence the company's future will be diluted by the new stock offering. Rights offering and subscription price. In a rights offering, all existing common stockholders automatically receive one right for each share they own. However, the number of rights required to buy one new share, the price at which the shares can be acquired, and the period available for exercising the rights will vary. Typically, the offer lasts only a limited number of days, and the preset purchase price is below the current market value of the stock. This preset exercise price is known as the subscription price. Investors who acquire rights have two viable options. First, the holder may choose to exercise the rights by submitting them to the issuer's transfer agent. Second, the rights may be freely transferred, traded, as they typically trade in the same market as the underlying stock. Warrants. A warrant is another type of derivative on an equity security that may be issued by corporations. Like rights, warrants give the holders the ability to purchase the issuer's common stock at a specified price, known as the subscription price, in the future. However, unlike stock rights, which generally have a relatively short life, warrants often have a maturity that is set years in the future. In fact, some warrants have a perpetual or endless life. Another distinction from stock rights is that a warrant subscription price is usually set above the current market price of the stock. Therefore, if the stock later increases in value above the subscription price, the holder of the warrant can realize a profit. Companies typically issue warrants in conjunction with an offering of stock or bonds. By including the warrants, investors gain an added incentive or a sweetener to purchase these issues. Warrants can usually be detached from the securities with which they were originally issued and sold separately. Intrinsic value. If the stock's market price rises above the warrant's subscription price, the warrant holds intrinsic value. For instance, if the warrant's subscription price is $30 and the stock's market price is $33, then the warrant has intrinsic value of $3. In other words, the investor could acquire the stock for $30 and sell the shares for $33, resulting in a 3-point gain. However, to account for the chance that the stock's price may rise further before the warrant expires, the actual value of the warrant may surpass its intrinsic value. Miscellaneous equity rules. FINRA Rule 22-61. Disclosure of financial condition. Upon request, a member firm must make available for inspection by a regular customer the information related to the firm's financial condition as disclosed in its most recent balance sheet. The balance sheet may be delivered to a customer in physical or electronic form. FINRA Rule 2262. Disclosure of control. Relationship with issuer. A brokerage firm with a control relationship with the issuer of any security must disclose this fact to its customers. The disclosure must be provided either before or at the time of executing a transaction in the security. Two situations where a control relationship exists are if the member firm is a publicly traded company or a subsidiary of one. For example, if a customer has an account at LRR Investments and is purchasing 1,000 shares of LRR Incorporated, which is listed on the NYSE, LRR Investments must disclose the existing control relationship between both firms. SEC Rule 10-B18. Purchases of certain equity securities by the issuer. For various reasons, an issuer of securities may be tempted to buy its stock to increase the price. To minimize the risk of manipulation, the SEC has established Rule 10-B18, which regulates how an issuer or its affiliates may purchase their own stock in the secondary market. Legitimate reasons for issuers to buy their own stock in the open market include stock buyback plans or funding employee stock purchase plans. Safe harbors under 10-B18. The SEC will not assume that an issuer is attempting to manipulate its stock price if the issuer adheres to the following conditions. Only one broker-dealer is used to place bids and make purchases during any trading session. Purchases are not made during certain times of the day. Issuers are prohibited from making a purchase that is the first reported transaction for that day and from making a purchase during the last 30 minutes of the normal trading day. If the issuer's stock is actively traded, this purchase prohibition changes to within the last 10 minutes of the trading day. The bid or purchase price of securities is limited to certain prices. The price may not be higher than the highest independent bid or the last independent transaction price, whichever is higher. For example, if the last independent transaction was $23.53 and the current bid-ask spread is $23.50 to $23.60, the highest price at which the issuer may buy its stock is $23.53. The amount of stock purchased on any single day is limited. The total volume on any single day may not exceed 25% of the average daily trading volume, ADTV, for that security. As we conclude this segment, we invite you to show your support by liking this video and subscribing to our channel. It is a simple click for you, but a huge support for us, and it is entirely free. To be among the first to be introduced to bonds and to excel in the SIE exam, please turn on your notifications. Thanks.